Welcome to the Political Risk Podcast, where geopolitical risk and insurance markets meet. I'm your host, David Benyon, and I'm joined for this episode by Cosmo Warner, Director, War, Terrorism and Political Violence at Price Forbes. Our theme for this episode is political violence broking a multinational client strategy in a complex threat environment. Cosmo is an experienced broker, having previously worked at Aon, New Dawn, and for the past 5 years at Price Forbes. Price Forbes has a global specialist broking team focused on terrorism, political violence, war and hostile risks, structuring and placing some of the largest and most complex risks into the London and international markets. And last year this included the largest single terrorism placement in the global marketplace. After so much PV business gets placed and renewed around New Year, this conversation, recorded in January, explores how London's specialist market is navigating a complex mix of highly competitive soft pricing, emerging loss activity, and evolving client expectations. The Price Forbes team has grown considerably over the past decade, and our discussion includes a look at the composition and structure of the broking portfolio, examining where demand is currently strongest, and why London, both through Lloyd's and the company market, remains the preeminent hub for PV placement, while also considering where competitive pressures could challenge that position. Recent loss events form a central thread, assessing which claims have been most instructive for the market and how underwriters are responding in a highly competitive environment. The conversation also probes the quality and transparency of information flow around claims as carriers navigate sensitivities involved. Finally, the focus turns to client strategy. We consider how brokers balance cost pressures for multinational buyers against the risk of inadequate cover, gaps as well as duplication, particularly where terrorism and broader PV perils intersect with property programs, for instance. The episode closes with advice on how insureds can use today's soft market conditions to build resilience and avoid painful surprises when the cycle, at some point, inevitably turns. Right, let's get into it. Cosmo, welcome to the pod.
Thank you very much.
We're in the new year now, so we're just past a lot of business being renewed at the end of last year.
Certainly.
On the 1st of January. So maybe that's a good place to start. I mean, just anecdotally talking to some of people on the other side of the fence, the underwriters, we know this is a market under pricing pressure. A lot of clients did get some pretty amazing discounts on what they could have got a year ago. So yeah, it's pretty competitive. But what's your broker side view on renewal?
You've nailed it on the head, really. It is competitive. The market has softened significantly and we're really having to put out all the stops to try and stick with it. Rates, they've plummeted in certain areas. Certain regions have certainly suffered more so than others, with markets coming in specifically and targeting those as real growth areas for them and being super competitive. So, certainly I can cite on the LATAM side, our LATAM team, who, I'll touch on later. They've had to really look to push the markets as hard as possible. But elsewhere, we are seeing reductions. But by and large, it's kind of making sure that we are getting out ahead of it. That client retention is essential, making sure that we're pushing our markets through our various different product offerings, is where we're adding value at the moment.
Let's get into your own role and your book of business at Price Forbes. So you're responsible for PV and terrorism portfolio across the globe. So what's the current makeup of the book?
Absolutely. We've really looked to structure the team to ensure that we've got regional expertise for each one of our clients. As I mentioned just earlier, we've got dedicated teams for Latin America. We've got a dedicated team then for North America and the rest of the world, which is the piece that I head up, that I look after for the team. So, the book today it's genuinely international and pretty sector diverse. We place risks across anything from real estate and energy, infrastructure, transport, to hospitality and financial institutions. So, all of these clients, and particularly multinationals, they're looking for cohesive and cross-border PV solutions. So it's pretty diverse and demanding. But yeah, that global book it's grown quite significantly in the last 18 to 24 months in terms of its spread. I'd probably break it down into 3 key areas. First, looking at Europe and North America. North America, which of course continues to be really the majority of our portfolio, where the concerns around, lone actor extremism, ideological violence, and the active assailant type events have driven clients to renew and buy anew as well. The second area, I'd say, is probably the MENA region and parts of Africa, where again, we're seeing geopolitical instability and civil commotion risks, encouraging clients to broaden out from their traditional terrorism covers. And then finally, I'd say there's a strong shift just towards that wider political violence protection, SRCC, malicious attack and threat response, along with non-damage BI, which during the slightly harder market, of course, those, certainly the non-damage BI extensions and those CBI sublimit were restricted, but we were able to offer those again. And certainly clients really want their policies to respond to that grey zone area, I guess, of modern violence, where incidents don't always meet those older terrorism definitions. But, crucially, we manage, I guess, a portfolio to ensure a pretty healthy balance, maintaining profitable, more benign regions alongside more challenging and hostile territories. That disciplined mix kind of positions us strongly with markets, allowing us to continue to procure capacity and secure capacity for our clients in higher risk geographies, but also ensuring that insurers are well rewarded with stable and sustainable and diversified business as well. So overall, the book's healthy. It's certainly global, and it's increasingly weighted towards holistic and flexible PV programs rather than that standalone terror product historically.
Let's focus on you for a moment. So what's been your route career-wise into this market? How did you get to where you are today?
Dave, great question. How did I end up here? So I actually started my career up to 10 years ago. Started it funnily enough, actually in financial lines. So totally different sector of the market. I started off a brilliant broking house called New Dawn Risk, which they gave me, after a couple of years worth of plugging away at work experience, they very kindly and charitably offered me a graduate job. And that gave me a foot into the Lloyd's market. And then, I first got a sniff of the PV world whilst running with a couple of incidental opportunities whilst at New Dawn. Whilst, some of the existing clients, we obviously did financial lines, but some of those clients were looking for that PV cover. So I had a couple of instances where I was looking for that coverage and along with their standard liability cover. And that's where I really got a flavour for it. And then just personally speaking, without giving you, a full life story, we were actually brought up overseas. My parents were expats, and we lived across everywhere, really, in the Middle East and Africa. So anywhere from Egypt, Senegal, Equatorial Guinea, and then we had a pretty eventful period, to say the least, in Tripoli, Libya, of course, where we were evacuated, all very dramatically. It was during the Gaddafi overthrow, yeah. So we were literally landed in Tripoli, and the following day was the first day that the rebels decided to actually go into Tripoli to see if they could
oust the colonel.
Oust the colonel, exactly. So all very eventful and probably a story for another time. But, that gave me a real experience, I guess, for that kind of quite literally political violence. So having experienced that all firsthand, I guess it's safe to say that I developed a pretty natural interest in geopolitics of those regions. And more aside to that, also just, the cultures. The PV market, having got a flavour for it, it resonated enormously. And I guess kind of proved a pretty natural segue back into that world. It's interesting to see that, of course, even the recent events in Venezuela, which, funny enough, I was born in Caracas, was a pretty timely reminder of that connection. So a very different place back then. I've actually held a Venezuelan passport up until the age of 17, which, whether or not that can be published on air, I might be called back for some military service. But I was then actively looking to go into the PV world, and Aon very kindly offered a role for a couple of years, which I took, and it was a great place to get to know the marketplace and learn a bit more about the product. And eventually ended up with Ed Black, who is our global head of political violence at Price Forbes, and haven't looked back. So here I am.
Well, the London market is such a hub for this business. I mean, clearly you mentioned Venezuela, and if you went to Miami, that there would be those who would say that's a natural hub for the LATAM business, fair enough, and clearly there's a lot of business done around the world, places like Dubai as well. But London is still such a natural concentration of this business and talent and expertise, and a lot of it done here. So what do you think gives London the edge when it comes to PV placement? Is it still a natural centre for all this business? And whether that's through Lloyd's or through the company market, and how or where do you think that edge could erode if we're not careful?
Again, great question, one that we're thinking about and reviewing, regularly. I mean, the bottom line is absolutely yes. I'm sure that London remains the hub for political violence as a line of cover. I would probably boil it down to three things. First of all, the concentration of expertise. Lloyd's and the company market, it really houses the deepest bench of PV underwriters anywhere in the world. And I guess that experience shows when structuring complex and emerging risk programs. Secondly, London can deploy large flexible capacity, which is essentially, again, for political violence. Because often these risks require syndicated placements and bespoke wordings. And certainly clients value that ability to tailor solutions. And that's not something that is always available locally and within the company market. And thirdly, I mean, this is obviously cliche, but is absolutely true. It's that ability to benefit from close broker and underwriter collaboration. PV risks are changing daily, and having that ability to just speak to an underwriter face to face and refine terms, in real time is a genuine advantage. But we're under no illusions, of course. That edge, it's not guaranteed. Regional hubs like Dubai and, of course, Singapore and even in Bermuda, they are getting stronger and stronger. And if London becomes slower, less agile, or overly rigid on pricing and appetite, then business will naturally flow to these other areas. There's that matter. And then there's, of course, risk around operational efficiency. If we don't continue modernizing, then I guess the turnaround speed could become a competitive weakness. And then finally, London, quite simply, just again, another buzzword, but it's got to continue to innovate, especially around these hybrid threats and cyber-enabled physical damage and social unrest exposures. If we fall behind there and others are really piling in on it, focusing on it, then they'll fill the gap. So don't get me wrong, absolutely. London's strengths.
I mean, we are seeing that, aren't we, with things like, well, on the threat side, grey zone threats, hybrid warfare, and that PV is a comprehensive product, which sort of it's whether you're getting the whole thing included or certain things you might turn on and off. You already mentioned BI, but active assailant, SRCC, not wanting to take a traditional terrorism cover where you're worried about whether the event definition covers what we're seeing because the threat environment is evolving. So it does feel like we are getting the right sort of innovative policies.
Absolutely. And people, we are certainly within the team, we are tailoring specific solutions for those kind of evolving gaps and areas in the market where, I'll touch on these actually in a second, where these have really popped up and we're having to kind of get out ahead of it, big one. But just to finish actually just very quickly on that, I do want to stress that those are concerns, but London's still very real. We are still absolutely the flagship area for PV. But we've got to make sure that we maintain, agility and openness to innovation and continue to invest in that market efficiency. Otherwise, others will catch up.
Let's talk about some recent loss events. Very recently, or go back as far as you like, but are there some you think are particularly noteworthy? Things that have stood out to you about new claims coming in?
Certainly. I mean, the market's certainly softened, but absolutely there are still some pretty significant losses that are coming in. Probably the most notable losses of the past year have probably concentrated in Israel, certainly in the last 12 months. Obviously, client confidentiality, so Nene's mentioned, but, large energy clients and certain losses, north of 250 million on a 100% basis. So, big, sizable losses. And then elsewhere, we've got just elsewhere and across in the Middle East, losses exceeding 50 million. And we had another one in the last few months as well, which was in more sort of Central Africa of over 75 million. So those losses alongside, very sadly, the kind of the steady flow of active shooter claims that we continue to see occurring in the States are flowing into the markets. But as I said, these losses are, for clients are obviously confidential, but the profiles of these are pretty flagship accounts where severity is anticipated, and it's priced for. We speak to underwriters pretty regularly about this stuff. And for those big flagship accounts, they just stress that these outcomes represent the cost of doing the business. And I guess that's a real demonstration of where Lloyd's adds value, because it's the cost of doing business in the current environment rather than it being an underwriting surprise. And they prepare themselves for that. So, the broader takeaway, I guess, is while overall PV market profitability kind of remains intact, there's certain subsegments that appear loss-making when isolated. But, new claims don't indicate a structural shift necessarily. They reflect more persistent volatility consistent with current realities.
Which perils have those triggered then within PV?
They would cover anything from terrorism in certain areas to the full suite of PV perils. And there have been absolutely some big discussions around that. And certainly I mentioned the grey areas earlier. And actually that's a really good topic, is where there is confusion, disparity and miscommunication education on what appropriate perils are being bought in certain regions and where the disputes are lying in the courts. So we are tailoring solutions for certain clients in certain areas. And for those that I've just mentioned, they are, by and large, they've been full political violence covers and, of course, as I said, the active shooter being active assailant products.
Well, given that we've already talked about the competitiveness of the market, but there are some of these loss events taking place, clearly you're a broker, but do you think the underwriters are treating these events as outliers?
No, I wouldn't say that they are seen as outliers, to be honest. I think, the markets acknowledge that the soft conditions, they continue to pressure price adequacy and terms, particularly for those that are carrying meaningful peak exposures in their books. But even so, they're not reacting with urgent blanket pullbacks or treating events as pure outliers. Instead, they're doubling down on discipline, really. Risks are absolutely assessed on individual merits. Capacity is deployed selectively. And there's a deliberate effort to hold rate in certain regions and segments of industry sectors where recent loss activity has been most pronounced. I guess, selectivity really remains central. Several markets are avoiding territories where the rate versus losses just aren't stacking up. Ukraine being the most blindingly obvious example. But looking forward, underwriters are broadly expecting instability to continue and to be quite frank, without sounding a bit doomsday, it probably intensify into 2026. We see it regularly in security reports from a lot of our partner consultants. And, the market's response is measured rather than it being reactive. They maintain their appetite parameters that they set out and they protect against their combined ratio targets. And they just have to avoid chasing top line where pricing conviction is lacking. So in short, consistency and sustainability, really, I think, over opportunism.
Clearly, we live in interesting times, and anyone who is tuning into, as we were talking about earlier, events in Davos, the geopolitical mood music remains very interesting, should we say. But that does not to say that everything's going to blow up at the same time. It's still very much possible to navigate this environment.
Absolutely. But to that exact point, it's really interesting to see, quite literally, these political changes are impacting our policies in certain ways. And certainly those policies were originally responding very differently to how they'd respond now, just by the nature of leaders in government amending how they define terrorists. And, certainly we've seen that in Latin America. And so we're having to stay pretty fluid. And as you said, it's changing kind of day in, day out.
I wanted to also ask you a question about transparency and information flow with some of these losses. Obviously, a lot of it is quite sensitive, but how cautious are carriers around how they discuss exposures and therefore price them?
This is an area where Lloyd's has actually showcased real value and remain very supportive to clients, really. So just on your question about information flow and transparency, the feedback we get from our underwriting partners as and when losses come through is it's business as usual for the PV market. Especially you look at areas of Ukraine or Palestine and the Middle East, inherently challenging in the early aftermath of events, particularly where the access is restricted, but not materially worse really in recent months. So experienced markets are accustomed to interrogating partial data and having to sort of triangulate sources to collect it. But whereas information is insufficient to meet threshold standards, they are prepared to step back. And we saw that a lot in the early stages of the Ukrainian conflict, where certain elite syndicates in the sector were being proactive in trying to get not on the ground as such, but finding means to be able to assess losses and support clients rather than backing away and stressing that insufficient information was being provided. So they were ready to accommodate and absolutely showed the value of Lloyd's, where we're really trying to come to the table and meet these claims and have them paid for. Broker dialogue and pricing hasn't really materially shifted. Conversations remain pretty open and pragmatic, with continued scrutiny over event data and exposure articulation. I think one area that is probably just worth mentioning that is of concern to the market, which I guess feels a little bit more out of their control, is probably concern over terrorism liability. So when I say it's out of their control, it's certainly within their control, but maybe been overseen in the past. Is terror liability, which many of them view as underrated at the moment relative to the respective line sizes that are being put out. And it's an area really that I think could generate quite a painful market event if a large event were to crystallize. So overall, there's no broad-based tightening as such on transparency grounds, rather just a continued insistence on data quality and clarity to commensurate with the risk being underwritten.
So we've talked a lot about the PV market from a perspective, clearly your own as a broker, but also how things look for the underwriters and the claims coming in from their perspective. But thinking about broking advice and client strategy, some of these multinational clients, when you're having conversations with them, they must be under cost pressure themselves to manage their insurance spends. How are those conversations going, especially where you've got PV and property policies potentially overlapping in some areas, coverage lines blurring?
this is kind of bread and butter is not the right word because it's not always that straightforward, but certainly these are the questions that we're facing pretty much every day with our clients. And that's where absolutely us as a broker, that's really where we provide the value to make sure that the right coverage is being purchased and to ensure that they're not overspending. So when we look at multinationals under cost pressure, the first thing I'll probably do is shift the conversation from premium spend to portfolio efficiency. Political violence, as I'm sure you're aware, it interacts very closely with property in very specific ways. And the key is helping clients understand where overlap is healthy and where it's actually costing them more. So I start by mapping their existing programs across property, terrorism, political violence, and any other crisis management covers. And very often you find duplication in some places and those gaps in others. So from there, we'd take a look at what should sit where, what is more efficiently insured within the property tower, what requires dedicated PV capacity, and where blended cover might give them clearer protection at a lower net cost. It goes without saying, of course, client's king and the client appreciates transparency. So if we can show them a structure that reduces uncertainty, avoids double buying and preserves the breadth of cover that they actually need, then they're much more comfortable making informed decisions, even in a cost-constrained environment that we're in at the moment.
When we speak of add-ons to policies, and BI is a good example of that, thinking back to COVID and having add-ons to property policies. But BI can be an add-on to a PV policy, and you get to the point where, in theory, you could have add-ons to add-ons. But PV, as we've already talked about, is now quite a broad, comprehensive suite of perils within it. It doesn't really make much sense to have. I'm guessing, you tell me if I'm wrong, to have PV as an add-on to a policy to a generic property policy, only to then talk about having a comprehensive PV approach and add-ons to that. It seems like if I was drawing that as a diagram, it's quite a messy, long chain of diagram. Where are clients landing on that? Is that how they see it? Or would they rather start with a PV policy at the beginning of it?
So absolutely. So the bottom line to it is that under a property policy, you're never going to be able to get the full suite of cover that you get under a standalone PV policy. The property market had historically offered sublimits certainly for SRCC, so strikes, riots, civil commotion. And that's where the PV market really stepped up and was able to assist clients because it was able to offer a more holistic and more comprehensive line of cover than what was being offered from the property programs. The other thing that's worth mentioning, of course, is, whilst a sublimit on a property program for PV could be isolated and standalone in its own respect, there is the risk of having a sublimit that is included within the overall limit of a property program. So whilst a property program could have attritional losses for all of its standard or risks, perils, you might end up not having the capacity and any coverage for your political violence exposures. So coverage is one thing, and I think having that standalone program, certainly you can get a more wider reaching, comprehensive amount of cover than you would do under your property.
We've talked a lot about duplication of coverage, but to take it from the opposite direction, looking at gaps in coverage, I assume that there are going to be some organizations where that really is the problem, and they have just thought they needed just terrorism cover historically. So how do you go about guiding them towards understanding the broader perils and the potential cost implications if they get that wrong?
Yeah, no, absolutely. And we kind of touched on this briefly earlier. I'm glad we've got a chance to expand on it because, I mentioned that the change in leadership at government level can amend the definitions of how terrorism is defined. And certainly that, again, mentioning really adding value as the broker is understanding where the perils, where they vary and where they're most applicable. You mentioned earlier the type of losses we were getting in the big loss scenarios that I mentioned earlier in Israel and the Middle East. And it's not immediately obvious to clients what they should be buying. And I think certainly a lot of them, the risk is that they think that terrorism alone does cover them, and they are unaware of how today's threats are kind of evolving. So my approach is education through actual scenarios and loss examples, rather than just using technical jargon and corporate language, is actually taking them through real events that give them...
Well, there's no shortage of examples, are there?
Well, no.
Well, you have a terrorist group, but then when so many rockets fly over Israeli airspace, it's been classed as a war risk event previously, and therefore coverage might not be included. And then you can talk about sabotage events that would sit within terrorism definitions.
And that's exactly it. And we kind of just look at, Dave, as you rightly mentioned, we look at events in the Middle East. That is probably the clearest example of that challenge, is where There have been ongoing debates, you literally said it, around whether an act is constituted as an act of terrorism or is it constituted as an act of war. And, people who are historically clients who are historically buying purely terrorism policies claiming that it was an act of terror, markets pushing back and saying it's an act of war. Those are the grey areas really that we're trying to iron out and that we need to keep on top of.
And the other example I mentioned, that there's sabotage, coming within terrorism.
Yeah.
But then again, that's part of that hybrid warfare piece. I'm thinking more about Europe now rather than the Middle East,
Sure.
I guess, but it could apply to both. But where you see if the malicious actor is the Russians and you've got sabotage attacks on Polish railways and shopping centres.
Pipelines.
And pipelines and the like. But then the same hybrid warfare strategy results in SRCC events potentially if you've got Russian-sponsored, even if they don't know they're doing it, activist groups or damage in that sense, then that would be an SRCC thing. So that wouldn't necessarily be covered within an old terrorism policy.
That's where we really take a proper look at the data and a proper look in the regions to make sure that we're looking at these kind of loss events that have happened historically and make sure that we're tailoring the right coverage to them, because the cost of getting it wrong is costly. Buying too narrowly might well save on premium, to just say you want to buy your standard terrorism policy because it's a lesser amount. But as you mentioned, an uncovered SRCC, so strikes, riots event or a malicious attack loss, it could be many multiples of that saving. So once clients understand the volatility and the real world consequences, they see the value in broadening cover, not for the sake of just buying more insurance, but actually for the sake of protecting the business properly in the long term.
Some of the grey zone examples, certainly I was thinking of in Europe, when you've got Russian hybrid warfare, it's very conceivable they would use organised crime groups, for example. But let's look towards another part of the world, so Latin America. So much Latin American organised crime problems. You've got drug cartels. Are there any issues there in terms of how those groups are classified, whether something would or wouldn't be covered, depending on how they're defined?
Yeah, absolutely. The big talking point was last year when the president decided to define these organized crimes, these cartels, as terrorist groups. So what we saw there was understanding the importance of the law and jurisdiction and where it's defined on the policy, because a number of North American clients actually were benefiting, I guess, in the sense that they had L&J being stated as the United States. So those that bought standalone terrorism policies that had exposure in those regions essentially were able to claim under the terror programs. But others who were actually, was just under local law and jurisdiction in Mexico and Colombia and such the like, they were no longer able to claim if it was a terrorism policy and that it was an organized crime event. So I guess the importance there and the kind of the grey area, it just lies around making sure you understand where the jurisdiction is for each policy and ensuring that you are speaking to the markets about the right cover. So where organized crime is the concern, making sure that it explicitly is included in wording in the policy and doesn't remain silent. So it's essential that as brokers, we really remain ahead of all of these considerations and ensure that the clients are well protected.
I think that's another advertisement for why, you cannot expect to engage with all these threat landscape changing risks whilst just trying to buy the same old policy year in, year out for a decade or more, or certainly try and do it to the property market, because you don't have anyone with that expertise at the other end of the phone.
Exactly. And that's it, is that we sit in day in, day out, we sit in calls with a number of security partners and they're flagging these issues. And as you rightly say, the property market are looking after hurricanes and wildfires, and they don't have the ability and the time to be able to look at, all things in all areas. So the political violence market, really, that's where we specialize, and we're keeping on top of all of these trends and these themes. And it's important that we continue to do so. And that's where, we should really be coming to the table with our clients to make sure that we're getting the right cover to them. And if they're not buying it, then at least we're suggesting it so that they're ready for that, any change in landscape, as it were.
The market is obviously so soft, and I can't see what would cause a turn, but there always is something that's always cyclical. So whether that's in just over the horizon or far down the line, what kind of healthy habits do you think buyers should form today so that if or when conditions do tighten at some point or other, they're not caught out by that? What do you think sort of healthy habits?
Yeah, the soft market, it creates good opportunities, but it can also create complacency, to be honest. And for our clients, the habits that will protect buyers later are the habits probably that they form now. So first thing I kind of suggest to our clients is just the importance of clean, consistent data. When the market, as you mentioned, when it has to tighten and it has to harden. And when that does happen, underwriters will become more selective. And the clients we've got who are providing robust data and clear information on their schedule of values and the rest of it, they'll maintain access to capacity and competitive terms. Secondly, I should think, quite simply, just engaging early. Buyers need to get in front of markets as soon as possible and not wait until the 11th hour at renewal. And, the old chestnut that the insurance world is, building relationships and giving the market time to understand your risk is critical when capacity does become a little bit more cautious. So I just encourage clients to kind of avoid over-optimizing their programs in the soft cycle. Things like stripping coverage back and reducing limits or relying on, as we mentioned earlier, the narrow terrorism definitions may look efficient today and provide you the cost saving that looks great in front of your CFOs, but it leaves your businesses like really vulnerable, when conditions harden or when the loss patterns do eventually shift. So the organizations really that fare best in the tougher markets.
This is a great time to get more comprehensive cover.
And the ones that, as I said, that fare best in those tougher markets are the ones that maintain balanced and sustainable programs throughout the cycle, whether it's soft or hard. So yeah, I'd say absolutely not getting complacent and sticking to that comprehensive cover will stand you in good stead.
Cosmo, it's been a lot of fun. Thanks a lot for coming on the podcast.
Not at all. Thanks, Dave. It's been an absolute pleasure. Thanks for having me on.
And that concludes this episode. It's already been a busy start to the year, but there's a ton of new episodes in the works for the coming weeks. And I'd just like to thank my wonderful guest for this episode, Cosmo Warner at Price Forbes. Please remember to subscribe, like, and leave me a rating or a review, all that good stuff. And until next time, thanks for listening. Please tune in again. I've been your host, David Benyon. Production was by Peter McGill, and Lawrence Durkin made the music.